Welcome to Listen to Riches. Today, I will discuss a book titled The King of Capital. It narrates the fascinating growth story of the global private equity giant, Blackstone, and unveils the seemingly mysterious world of private equity. It also provides insights into the financial development of Wall Street. First, let's introduce Blackstone. Blackstone is one of the world's leading private equity investment firms. I will explain the term private equity in detail shortly. We all know that Wall Street boasts many long-standing investment banks, some with over a century of history. However, Blackstone, founded in 1985, has thrived in just over 30 years, navigating multiple economic recessions and crises, continuously expanding to become the dominant force in the private equity industry. Hence, Blackstone has earned the moniker the King of Capital, and this book is aptly named after this title. It's referred to as the King not just because of its scale. When it was founded, it had a mere $400,000 in capital, but today its market value surpasses $200 billion, and it manages assets exceeding $400 billion, ranking among the world's top players. The second reason is its influence. Blackstone's operational style has had a profound impact on the industry's development. Over these 30 years, Blackstone has also created many renowned cases, such as the Hilton buyout, which alone generated a staggering $14 billion in profit, making it one of the most profitable deals in private equity history. It can be said that understanding Blackstone means understanding the private equity industry. The abbreviation for private equity in English is PE, a term commonly thrown around in financial circles. It may sound mysterious, but the business model is not overly complicated. In simple terms, private equity firms engage in three key activities. First, they identify opportunities. They select target companies, acquire their equity at the right time. And these companies are either significantly undervalued or have substantial growth potential. Second, they secure financing. They design appropriate financing structures, leverage financial instruments, and raise the necessary funds for acquisitions. Third, they buy low and sell high. After completing the acquisition, they help the target company increase its value and choose the right time and method for an exit and cash realization. Why did Blackstone manage to rise to the top in the global private equity industry? It's because they excelled in these three aspects, resulting in significant returns for their founders, partners, and investors. Moreover, the company's influence on the world economy has continued to grow. The authors of this book, David Carey and John Morris, are both experienced financial journalists for top American publications with years of reporting and writing about the private equity industry. Their captivating stories will inspire you by exploring the rise and fall of Blackstone and provide you with a better understanding of the private equity sector. Now, let's focus on three key aspects. First, how Blackstone capitalized on the major trends on Wall Street and leveraged its strengths to quickly rise to prominence. Second, how Blackstone became the capital king of Wall Street and the secrets behind its success. Third, the role of private equity firms like Blackstone in the economic system. Are they greedy demons or angels who rescue people from financial crises? First, let's hear the story of Blackstone's early days and how its founders, Peterson and Schwarzman, transitioned from their roles at the renowned Wall Street investment bank, Lehman Brothers. In the early 1980s, Lehman Brothers teetered on the brink of collapse due to economic recession and trading mistakes. Although the company eventually averted the crisis, it got entangled in internal strife. This made Peterson and Schwarzman quite disillusioned, prompting them to break away from Lehman and venture out on their own. Thus, in 1985, with a capital of $400,000, they founded Blackstone. Typically, large investment banks diversified their product lines extensively, but Blackstone had a different vision. They wanted to focus on one thing: private equity investment, a term I'll explain in detail shortly. This industry, as mentioned earlier, involves raising capital from clients, acquiring equity in target companies, and eventually selling it for a profit. Since the core operation revolves around acquisitions, it is also known as equity buyouts. Why did Peterson and Schwarzman choose this venture when they decided to start their own business? For one, both of them were genuinely interested in this field, having gained significant experience in investment banking. But more importantly, during that era, equity buyouts had become one of the fastest-growing and most prominent businesses on Wall Street. It's safe to say that Blackstone's inception perfectly aligned with the major trends in the financial industry. The emergence of this trend wasn't coincidental. Before the 1960s, the United States experienced a period of diversification, with large corporate conglomerates aggressively expanding into various industries. However, in the 1970s and 1980s, many of these conglomerates discovered that diversification wasn't a viable strategy. Consequently, they began divesting assets outside their core industries, creating numerous targets for equity buyouts. Simultaneously, a brokerage firm, Drexel Burnham Lambert, pioneered the use of junk bonds as a financial instrument, providing the necessary funding for equity buyouts. Drexel alone issued $80 billion worth of junk bonds in the 1980s. Consequently, equity buyouts entered a phase of explosive growth. The decision by Peterson and Schwarzman to enter this field reflected their insight and judgment. However, choosing the right path doesn't guarantee smooth sailing for a small company with an initial capital of just $400,000. As mentioned earlier, excelling in equity buyouts requires excelling in two critical areas, namely, finding opportunities and securing financing. Finding opportunities involves carefully selecting investment targets, which should either be undervalued or have significant growth potential. It means acquiring them at a low price today and selling them for a high price when the time is right. Securing financing, on the other hand, involves attracting investors, typically by establishing investment funds. In specific project operations, apart from utilizing investment funds, companies often employ various financial leverages, such as borrowing from banks, to maximize the funds available for acquisition transactions. Therefore, initially, Blackstone could only offer consulting services for mergers and acquisitions to their clients, earning a modest $50,000 from their first deal. However, the two of them didn't lose heart. They set an ambitious goal for Blackstone, aiming to raise a $1 billion investment fund. When it came to finding projects and raising funds, Peterson and Schwarzman leveraged their strengths effectively. Peterson, being the older of the two, had previously served as the Commerce Secretary in the Nixon administration, and during his time at Lehman Brothers, he had been the CEO, serving as Schwarzman's superior. He was well connected both in the political and business spheres. Schwarzman, on the other hand, was younger and brought strong professional expertise to the table, excelling in evaluating the value of potential acquisition targets and understanding when to exit for maximum returns. He also had innovative ideas for managing the company. Their strengths complemented each other. Peterson guided the strategic direction, focused on raising funds for the company while seeking project leads, and utilized his extensive network to make connections. Schwarzman handled the specific selection and assessment of projects, directly managing them. This powerhouse duo gave Blackstone a strong starting point right from its inception. However, the initial phase was not without its challenges. Despite their impressive network resources, Blackstone was still a new company with no convincing track record. They utilized various relationships accumulated over their careers to send business materials to hundreds of potential clients. However, over several months, all 18 institutions they had high hopes for rejected Blackstone. Ultimately, with the help of Peterson's personal connections, the UK-based Prudential Insurance Company agreed to invest $100 million, but with strict conditions. Nevertheless, this $100 million was a lifeline for the fledgling Blackstone. Even more crucially, Prudential was a long-established and powerful player, and its investment served as a significant endorsement for Blackstone. As a result, institutions started approaching them, including many Japanese organizations. At that time, Japan was in the midst of an economic bubble, with Japanese financial institutions holding significant amounts of cash and looking for opportunities to invest in the U.S. market. By early 1987, Blackstone had successfully raised $600 million. What did this $600 million mean for Blackstone? Firstly, as per industry norms, Blackstone could charge a 1.5% management fee each year, totaling $9 million annually. Secondly, for completed investment projects, Blackstone could also take a 20% share of the profits from the investment returns. For a company less than 2 years old, this income was sufficient for the company to survive. More importantly, with the $600 million in capital, Peterson and Schwarzman had the resources they needed to actively participate in the mergers and acquisitions market. They soon seized a golden opportunity. In 1988, the U.S. Steel Group intended to sell off its struggling transportation business as a package deal. Blackstone foresaw the recovery of the transportation industry and invested over $100 million from their own funds. They secured $600 million in financing from banks and completed the acquisition. The industry soon began to recover, and within 2 years, Blackstone had already earned 4 times their initial investment. When they sold all their shares in 2003, the returns for Blackstone and its investors had reached an astounding 25-fold, with an average annual return rate of 130%. This deal became one of Blackstone's early classic successes and a hallmark that attracted clients. The story above describes the early days of Blackstone's entrepreneurial journey. Investment in mergers and acquisitions is a high-yield industry, but high returns also imply high risks, especially during economic downturns or crises when investment and acquisition companies become particularly vulnerable. Why is that so? For one, it's challenging to find funding during such times. Secondly, companies or equity holdings that were acquired earlier are likely to face operational difficulties, plummeting in value, and they may become impossible to divest or even face bankruptcy. As a result, many older investment and acquisition companies did not survive, unlike Blackstone. So, how did Blackstone manage to weather numerous recessions and crises, not just surviving but growing stronger to become the king of capital on Wall Street? The following section explores the secret sauce behind Blackstone's success. According to the book, Blackstone's unique recipe for success can be summarized in at least 3 key aspects: cautious management style, a distinctive partnership operation model, and a robust capability for enhancing the value of acquisition assets. Let's start with Blackstone's cautious management style. The business of merger and acquisition investments often requires bold decision-making, sometimes even with an element of gambling. You need to believe that the equity you acquire today will substantially appreciate in the future. As an industry leader, Blackstone certainly did not lack the boldness to act when necessary. However, when considering the overall situation within the industry, especially compared to more aggressive competitors, Blackstone's style was noticeably more cautious. Let's discuss 2 aspects of Blackstone's approach: the prudence in resource allocation and the cautiousness in industry direction. Firstly, the prudence in resource allocation. Do you recall that when Blackstone was founded, it began with just $400,000 in initial capital, only a handful of employees, and a tiny office space? Although the private equity industry primarily relies on raising client funds for investments and doesn't necessarily require a substantial capital base at the outset, starting with $400,000 was modest. Even by industry standards, this sum was contributed equally by Peterson and Schwarzman. As seasoned Wall Street professionals, both had significant personal wealth and they could have easily afforded a more substantial investment. However, they deliberately chose this frugal start. Why? Because they believed that the path they had chosen should be self-sustaining in the short term and shouldn't require a significant infusion of capital. If the $400,000 were exhausted without the company generating profits, it would signify a flawed direction and there would be no need to risk more money. This prudent and level-headed approach was characteristic of their entrepreneurial spirit. Secondly, the cautiousness in industry direction. Blackstone preferred not to follow trends or chase hot sectors. The industries they chose for investment, such as hotels, tourism, food, and chemicals, often appeared less fashionable. Blackstone avoided the latest and hottest sectors for two main reasons. First, these trendy sectors are either uncertain with the potential for short-lived popularity or overly crowded with institutional investors, leading to overinflated equity prices that might have already exhausted their future growth potential. Therefore, Blackstone maintained a distance from such industries. This approach could mean missing out on meteoric rises but helped avoid the risk of sudden crashes. Blackstone excelled in traditional industry investments and sought opportunities within the cyclical fluctuations of these sectors. Even when dealing with emerging industries, they preferred projects that combined elements of traditional and emerging industries. For example, in the late 1990s, during the first internet boom, instead of directly venturing into the internet sector, Blackstone chose to invest in cable television networks. While this was a traditional industry, cable television networks could also be used for internet data transmission. Therefore, the rise of the internet had a stimulating effect on this traditional sector. In this industry, Blackstone meticulously selected 5 projects and earned profits exceeding $10 billion. When the internet bubble burst in 2000, Blackstone, due to its limited involvement in the internet sector, was not significantly affected. This cautious attitude was pivotal for Blackstone to navigate through recessions and crises successfully. Now, let's turn to Blackstone's unique approach to management. Blackstone pioneered a new model in the private equity industry by establishing branch operations controlled in partnership with its employees. It is widely recognized that the financial sector relies heavily on talented individuals, and the private equity investment and acquisition business model has an even greater dependency on top-tier talent. To attract and retain top talent, companies had to employ various strategies. For truly exceptional professionals, salary and bonuses were inadequate to bind them to the company. A common approach in the industry was to allocate company shares to these exceptional individuals, forming a partnership structure where the company was managed by partners. However, this approach often led to issues of diluted company ownership, and with more top talents on board, distribution of shares became a complex matter, often causing internal disputes. It's important to note that Peterson and Schwarzman left Lehman Brothers to start their own venture, Blackstone, largely because they could no longer tolerate the internal conflicts at Lehman. They certainly didn't want to repeat the same mistakes at Blackstone. So, what did they do? After careful consideration, they devised an entirely new co-ownership model. Instead of distributing shares of Blackstone to the exceptional individuals they aimed to retain, Blackstone would establish a specialized company in the area overseen by these talented individuals. This new company would be jointly owned by the individual and Blackstone. This arrangement ensured that the interests of these exceptional individuals were directly aligned with Blackstone, and within their respective domains, these individuals acted as their own bosses, having the opportunity to earn more by performing well. This approach differs from the partnership model commonly used in other industries, such as law and accounting, where the company's ownership structure is diluted. Blackstone's co-ownership model did not dilute the ownership structure of Blackstone itself, and the founders maintained strong control. This approach was highly effective in retaining top talent on Wall Street, and the specialized co-owned companies became pioneers for Blackstone in various business areas. For example, Fink, a leading expert in bond investments under Blackstone's umbrella, established a co-owned company with Blackstone called BlackRock. Sometimes it is translated as Blackstone in Chinese, creating a resemblance with Blackstone's name. Later, BlackRock became an independent entity and is now the world's largest publicly traded investment management firm, managing assets exceeding $6 trillion. Numerous specialized companies remaining under Blackstone's umbrella continued to expand its horizons, and this model exerted influence not only in the private equity industry but in various other sectors as well. Lastly, let's delve into Blackstone's impressive ability to add value to acquired assets. To become the king of capital in the private equity industry, the fundamental requirement is competency, the ability to earn tangible returns in merger and acquisition transactions. So, what does it take for private equity firms to succeed? In general, it requires three key competencies: the ability to raise capital, including attracting client investments and raising investment funds, as well as skillfully utilizing leverage to attract additional financial support for specific projects. Secondly, the capability to select potential investment targets and complete acquisition deals. Lastly, the ability to seize the right time and method to cash out and secure returns. Upon closer analysis, raising capital relies on personal connections, brand reputation, and adept use of financial tools and financial leverage. Identifying target companies involves insightful analysis and the ability to foresee trends and make predictions. When it comes to cashing out, it hinges on making decisive decisions and having a mastery of various methods of monetization, including IPOs. This book asserts that Blackstone excelled in all these aspects, exhibiting remarkable competence, but what truly sets them apart from their peers is their exceptional ability to enhance the value of acquired assets. This capability for adding value to acquisition assets is Blackstone's core competitive advantage. So, how does Blackstone achieve this value addition in acquisitions? One scenario involves contracyclical operations. Blackstone is adept at understanding the cyclical trends in different industries. They make acquisitions during industry lows and then wait to cash out when industry conditions improve. Even when the acquired company itself hasn't changed significantly, its value appreciates as the industry rebounds. Blackstone profits from the difference thanks to their expert judgment and understanding of cyclical fluctuations. Another scenario with a higher level of technicality involves Blackstone proactively aiding the target company in reducing costs, improving management, and even expanding into new business areas after the acquisition. Consequently, when Blackstone eventually decides to cash out, they can achieve a more substantial price differential. This differential encompasses the value of industry fluctuations and professional judgment, along with the additional value created through operational enhancements in the target company. Not all institutions can operate in this manner, but Blackstone excels in this regard. Consider the case of Blackstone's acquisition of Celanese, a German publicly traded company primarily engaged in chemical additives production. In 2001, during a relative low point in the chemical industry, Blackstone identified both the investment value in Celanese and numerous areas where the company's operations and management could be enhanced. Blackstone swiftly initiated the acquisition. On one hand, they engaged in extensive negotiations and haggling with Celanese management and shareholders. On the other hand, they rapidly secured the necessary funds from financial markets. In April 2004, Blackstone completed the acquisition of Celanese at a price of $3.4 billion, marking the largest private equity investment acquisition of a publicly traded company in Germany's history. However, Blackstone was not passive in this endeavor. They took a series of proactive measures to help Celanese enhance its operational management. This encompassed adjustments in management culture, increased management flexibility, overcoming previous bureaucratic tendencies, cost reductions, increased labor productivity, divestment of unprofitable businesses, and relocating some operations to countries with lower labor costs. Finally, Blackstone aided Celanese in expanding its business scope and improving its global market share for key products. These measures yielded immediate and substantial results. Within a year, cash flow had increased by more than 40%. By 2005, Blackstone assisted Celanese in going public in the United States. By the time Blackstone exited its investment in Celanese in 2007, they had accumulated profits of up to $2.9 billion from this acquisition alone. This became the largest single profit in Blackstone's history. These profits not only resulted from the overall recovery of the chemical industry and Blackstone's adept use of financial leverage, but were mainly attributed to the value created by Blackstone's assistance in improving Celanese operational management. This demonstrated Blackstone's powerful capability to add value to acquired assets. It's this proficiency that has enabled Blackstone to navigate through crises and establish itself as the capital king. The book raises an important question: what role do private equity firms like Blackstone play in the economic system? Are they angels or devils? Many individuals, including some in academia and the financial industry, hold a negative view of private equity firms. They often perceive these firms as ruthless, greedy entities that acquire target companies and dispose of them without any compassion. They are seen as ruthless in removing executives and employees and then auctioning off these companies like livestock. These critics argue that private equity firms are only interested in making quick money and profit differentials, contributing nothing to the development of the acquired companies or the overall economy. This perspective has long been prevalent. There is a classic business book titled Barbarians at the Gate, which tells the story of a group of Wall Street takeover titans battling for control of Nabisco. The choice of the term barbarians in the title reflects the author's attitude towards takeover deals. However, this book disagrees with such a viewpoint. The book argues that while private equity firms sometimes need to make adjustments to the businesses and employees of the target companies appearing tough, the ultimate purpose of these adjustments is to make the target company more appealing to the market, so it can be sold at a higher price when they cash out. The next buyer is not naive. If they are willing to pay more for the company, it indicates that the prior adjustments have indeed benefited the company. Helping a company through an acquisition and improving it can lead to cumulative improvements for the entire economic system. By helping undervalued companies gain greater recognition, private equity firms contribute to the value creation within the economic system. As long as they adhere to legal regulations, there's no need to resort to moral condemnation. Additionally, firms like Blackstone have consistently focused on benevolent acquisitions. A benevolent acquisition implies thorough communication with the original company's shareholders and management before the acquisition, considering their interests and needs. After the acquisition, most of the management team is typically retained. The private equity firm leverages its professional expertise to enhance operational management and facilitate value growth in the acquired company. The case of Celanese, mentioned earlier, is a prime example of a benevolent acquisition that resulted in value enhancement. In this acquisition, while Blackstone did reduce some positions during the process of cost-cutting and business adjustments at Celanese, they also created many new positions. These two factors effectively offset each other. By the end of the day, the reduced positions accounted for about 4% of the total number of positions in the company. Concurrently, labor productivity increased by almost 50%, company performance improved significantly, and market valuation rose. This demonstrates the value of these adjustments. When considering the history of private equity investment development, it is evident that during the early stages, quick in-and-out situations were more common, as were hostile takeovers and ruthless layoffs of the entire management team. However, Blackstone firmly adhered to the principle of avoiding hostile takeovers and led the trend of benevolent acquisitions within the industry. Under the benevolent acquisition model, private equity firms prioritize amicable negotiations with the original shareholders and management of the target company and seek their support. After the acquisition, most of the management personnel are generally retained, and the private equity firm employs its professional competence to help the target company improve its operational management and achieve value growth. The Celanese case is a clear demonstration of the value that can be created through a benevolent acquisition. Therefore, the book contends that it is because there are players like Blackstone who lean towards benevolent acquisitions and have the ability to help target companies achieve value growth that the private equity industry is not a devil. It is valuable and contributes to the development of individual companies and the economy as a whole. While Blackstone and the private equity industry have faced challenges such as the financial crisis, they still have significant room for long-term growth. With that, this book concludes its discussion. In the preceding chapters, we discussed the entrepreneurial journey of Blackstone, a company whose establishment marked the thriving trend of the private equity industry. However, their initial steps were fraught with challenges. Blackstone faced repeated setbacks in fundraising until they secured a significant investment of $100 million from Bauchine, which marked their first substantial stride. Subsequently, through the successful acquisition of the transportation business under the American Steel Group, they reaped an astonishing 25-fold return, truly setting them on the path to success. We then delved into how Blackstone navigated through numerous economic downturns and crises, revealing the key factors behind their ascent to the throne as capital king. This book maintains that their prudent management style, unique branch partnership operational model, and robust capabilities in enhancing acquired assets are the cornerstones of Blackstone's success. Finally, we explored the role that private equity firms play in the economy. Despite some negative aspects such as hostile takeovers and ruthless layoffs, this book asserts that private equity firms have also played a positive role in benevolent acquisitions and aiding target companies in achieving value growth, thus contributing value to the entire economic system. Blackstone, as a representative, has steadfastly adhered to the principle of benevolent acquisitions, setting a positive example for the private equity industry. Congratulations on completing another book. We appreciate your support and attention. Please subscribe to Listen to Riches, like this video, and share this valuable knowledge with your friends. Let's combine wisdom and practicality to achieve our financial goals and create a brighter future. Thank you all. See you in the next episode.